the secret of the guru, the investment psychology that builds long-term wealth. Hello, this is Sterling Invest, and this is not a drill. For a very long time, the secret to wealth had been shielded by a very select few. Now you are seeing and watching this. Take it as the saving power of the universe, revealing these secrets on this platform. It is not cheap, rather it is benevolent. Now, let us go into the secret. Most people believe investing is about finding the perfect stock. They think wealth comes from prediction intelligence, secret strategies, market timing, fast opportunities. But the longer you study successful investors, the more you realize something uncomfortable. The market rarely rewards emotional behavior for very long. And that changes everything, because many people enter investing believing the biggest challenge is understanding markets. But eventually they discover the real challenge is understanding themselves. Fear, greed, impatience, envy, panic, euphoria. These emotions quietly shape financial decisions every single day. And investors who cannot manage emotional volatility usually struggle during market volatility. Today we are going deep into the psychological principles behind long-term investing success. The lessons that separate disciplined wealth builders from emotionally reactive investors. Because wealth creation is not just financial, it is behavioral. The first misunderstanding most investors have, most beginners think investing means buying numbers on a screen. But disciplined investors think differently. They understand that every investment represents something real: a business, human behavior, economic demand, long-term productivity. This mindset shift is critical because emotional investors stare at prices. Disciplined investors study value, and those are very different things. When markets fall, emotional investors see, "I'm losing money." But disciplined investors ask, has the long-term value actually changed? That question prevents panic. Because markets constantly fluctuate emotionally, real value changes much more slowly. Why most investors enter markets emotionally? Very few people begin investing from pure rationality. Most people begin because of emotional pressure. Sometimes it is fear of being left behind, fear of financial insecurity, comparison, economic anxiety, the desire for freedom, social pressure, frustration with slow income growth. Money becomes symbolic. It represents safety, independence, control, status, relief, and symbolic things trigger emotional behavior. This is why people often chase trends, panic during crashes, obsessively check portfolios, overtrade, react to headlines. They are not just managing money, they are managing emotions attached to money. That distinction matters enormously. The market is a psychological environment. Most people think markets are driven only by economics. But markets are deeply emotional systems. Human emotion moves through financial markets in cycles. Optimism becomes excitement. Excitement becomes euphoria. Euphoria becomes overconfidence. Overconfidence becomes excessive risk. Then uncertainty appears. And suddenly, fear spreads. Panic rises, confidence disappears. Investors rush toward emotional safety. This cycle repeats constantly throughout financial history. Different generation, different technology, same psychology. That is why emotional discipline matters so much. Because eventually, every investor experiences periods where uncertainty feels overwhelming. Why emotional decisions destroy wealth? One of the biggest mistakes investors make is confusing emotional relief with decision-making. Those are not the same thing. For example, selling during panic feels emotionally relieving. But emotionally relieving actions are not always financially intelligent actions. The human brain hates uncertainty. During market crashes, people feel an overwhelming urge to sell, move to cash, escape volatility, do something, because action creates temporary psychological comfort. But successful investing often requires strategic patience during emotional chaos. That is extremely difficult psychologically, especially when everyone around you is panicking. The hidden power of long-term thinking. One of the greatest advantages in investing is time, not speed, not constant activity, time. Because wealth compounds quietly. At first, progress feels slow, almost invisible. But over long periods, disciplined investing begins accelerating dramatically. This is why consistency matters more than intensity. Many people interrupt compounding constantly because they chase trends, panic sell, abandon strategies, react emotionally, seek excitement. But compounding requires uninterrupted discipline. That is the difficult part. Not understanding the formula, maintaining the behavior. Why patience is financially powerful. Modern financial culture rewards speed. Everything feels urgent. Breaking news, market predictions, crash warnings, Next, big opportunities. Emotional headlines. But emotionally reactive investing usually creates instability. Patient investors operate differently. They understand. Not every opportunity must be chased. Sometimes the highest return decision is restraint. This is psychologically uncomfortable because humans associate activity with progress. But investing is one of the few environments where excessive activity often reduces results. Patience improves. Decision quality, emotional stability, long-term consistency, risk management. And over time, those advantages compound. The importance of simplicity. Many investors believe sophisticated strategies automatically produce better outcomes, but complexity often increases emotional mistakes. Simple investing principles consistently repeated over long periods can become extraordinarily effective. Examples include diversification discipline and investing, long-term ownership, risk management, emotional control, avoiding unnecessary speculation. Simple systems reduce emotional interference, and emotionally stable systems usually outperform chaotic strategies sustained by excitement. Why risk management matters more than excitement. Most people focus heavily on potential gains. Disciplined investors focus heavily on survivability. This is critical because avoiding catastrophic losses matters enormously in wealth building. Large losses create two problems: financial damage, psychological damage. After severe losses, many investors lose confidence, abandon strategies, become emotionally reactive, avoid future opportunities. That emotional damage can delay wealth building for years. This is why disciplined investors think carefully about downside risk, diversification, liquidity, emotional tolerance, long-term sustainability. The goal is not merely maximizing returns. The goal is surviving uncertainty consistently enough for compounding to work. Why most investors struggle during crashes, during strong markets. Almost everyone feels confident, but crashes reveal emotional weaknesses quickly because uncertainty exposes fear, impatience, insecurity, overconfidence, emotional dependence on markets. Many investors discover during volatility that they were never truly comfortable with risk. They were comfortable with rising prices. Those are not the same thing. True investing discipline appears during uncertainty, not during easy markets. The danger of identity-based investing. One of the most overlooked psychological dangers in investing is identity fusion. This happens when people emotionally connect self-worth to portfolio performance. When investments rise, they feel intelligent. When investments fall, they feel personally diminished. This creates emotional instability because markets fluctuate constantly. Your emotional stability cannot depend entirely on market conditions. Disciplined investors separate self-worth from portfolio fluctuations. That separation improves decision-making dramatically. Why noise destroys financial clarity. Modern financial media is designed for attention. Fear attracts attention. Urgency attracts attention. Conflict attracts attention. This creates a constant emotional environment where investors feel pressured to react continuously. But emotional overstimulation damages clarity. Disciplined investors filter information aggressively. They avoid becoming psychologically consumed by daily panic, constant predictions, emotional speculation, endless market drama, because successful investing often requires calm thinking during emotionally chaotic periods. The real meaning of financial discipline. Many people think discipline means restriction, but in investing, discipline creates freedom, because disciplined systems reduce emotional chaos. When investors build emergency reserves, diversify exposure, long-term plans, emotional rules, they reduce the psychological pressure created by uncertainty. Preparation creates emotional stability, and emotional stability improves financial decisions. The investors who usually win long-term over time. The market often rewards people who remain rational during fear, avoid emotional overreaction. Think long-term, prioritize consistency, survive. Volatility, manage risk, carefully avoid destructive behavior. This sounds simple, but emotionally, it is extremely difficult, because human psychology constantly pushes people toward impulsiveness, comparison, fear-driven decisions, emotional urgency. That is why emotional discipline becomes such a powerful advantage. The truth about wealth building, real wealth creation, is usually less exciting than people imagine. It often looks repetitive, disciplined, patient, methodical, emotionally controlled, and because it appears boring, many people abandon it too early, searching for faster emotional rewards. But over long periods, disciplined behavior compounds into extraordinary outcomes. That is the hidden power of investing. Not prediction, Not hype, not emotional excitement, but consistency sustained over very long periods of time. Final teaching: eventually every investor learns the same lesson. The market constantly tests emotional discipline before rewarding financial discipline, and the investors who master themselves usually outperform those trying desperately to outsmart everyone else. Because long-term investing is not merely about growing money. It is about becoming psychologically stable enough to survive uncertainty consistently. And in the end, that stability becomes one of the greatest financial advantages a person can ever develop. If you found this valuable, subscribe for more deep dive finance documentaries on investing psychology, economic resilience, and long-term wealth strategy. And in the comments, what do you believe is the biggest threat to modern portfolios right now? Inflation, debt, market bubbles, AI disruption, geopolitical instability. I'd genuinely like to hear your perspective.